Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's show, we work out whether Zip, Qantas and Crown are buys for the long-term patient investor. And we look at four unusual stocks viewers have asked us about: Telex Pharmaceuticals, Ingenia Communities Group, Nexus Minerals and Service Stream. We'll do that with Berman Invest Julia Lee and Tribeca Alpha Plus's Jun Bei Liu. Meanwhile, Morgan's Raymond Chan gives us two stocks that might be a good buy before they report very soon. And then Paul Rickard looks at the good performing super funds and asks, have you been doing better? Is your portfolio outperforming these super funds? If not, why not? We'll talk about that with Paul. So that's the show ahead. So let's kick off with Julia Lee, Berman Invest. Welcome to the program, Julia.
Great to be here, Pete.
Okay, so I've tossed a few stocks at you, and from my point of view, these are stocks that a lot of people have to be patient about because they might not do well in the short term. And also, I saw Zip's report last week, and it seemed pretty good, but the market wasn't too enthusiastic about it. Now, I know you analyse very closely. Why do you think the market wasn't too enthusiastic about Zip? Was it because all these new competitors are coming on the scene?
I think there's increasing competition, Pete. And when you see increasing competition, it means that it becomes harder to acquire customers and more expensive to acquire customers. So likely what we are going to see is an increased marketing spend happen. Zip also announced that it would be rebranding its QuadPay to Zip to be more in line with its ASX name. And that, of course, costs money as well. I often liken it to, when we saw the telecom sector opening up, we went from having just Telstra as a monopoly to having other players coming in like TPG and Vocus. And of course, that increased competition was bad news for Telstra because it was the one losing market share. So the more established players, they have a lot more to lose when there's increasing competition, smaller players coming in, and even larger players coming in like PayPal that we have seen, as well as Apple Pay planning to come into the space and talk that they're not going to be looking at late fees, which of course is about 20 to 30% of revenues at times for these buy now, pay later stocks. So look, I prefer to stay away from companies where there is increasing competition, even though the sector is growing, because it becomes much more harder to acquire that growth and more expensive to acquire that growth.
What about the fact that they've got 2.5 million customers and they are diversifying into different products, even talking about cryptocurrency as well? And I would have figured that the audience base would be rather on the youngish side and probably not great fans of the banks. So that made me think, well, they probably have long-term potential to grow that customer base.
Yeah, there's lots of potential, especially because of the demographics, as you mentioned, Pete. And Afterpay is one that has mentioned that it will be now expanding into banking services that won't be looking at making a profit out of those banking services, but use it as a retention tool. And of course, when you are looking at giving out money, any data that you have on customers is a great way to be able to manage risk. So having visibility into bank accounts, salaries being paid into account, cash levels, that type of thing, I think is invaluable. And the data side of things is, I guess, a side that we don't talk about very often, but seeing those spending habits of the millennials is a huge advantage. But on the flip side, you have these massive giants with a lot bigger wallets and more money to spend, like PayPal as well as Apple, looking to get into this space as well. And they have gotten into this space and they are spending money around. So the fact that they just have a sheer huge user base in comparison to the likes of Zip Pay just means that it's much harder for these smaller players now to grow.
Okay, let's go to one I know you do like and has been basically following your script, namely Qantas. And from the point of view of someone who buys it now and is prepared to wait a year or so, are they going to get a nice return?
Yeah, there's a few companies that are, I guess, are in the same bucket as Qantas. And this reporting season, I know that it's going to be a weak reporting season for companies that are exposed to things like tourism and are exposed to the lockdown. So I have a number of stocks on my watch list. So if we do get a poor report out of the last 12 months, that I'll be looking to acquire and buy out. One of those is Qantas. The other is Star. And I'm also looking at Woodside Petroleum. And that's because with all of these companies, I know that the Delta variant of COVID impacts negatively on the business. However, as vaccinations increase, hospitalizations decrease, and we can move forward to closer to a more normal world. So this reporting season, I think, is going to be interesting, not only from the viewpoint of the companies that will blow out the lights in terms of earnings, but also in terms of just making strategic acquisitions over the next 12 to 18 months. We know with Woodside Petroleum at the moment, there's concern around the oil price because of global growth concerns, because of the Delta variant. But come the first half of next year and the second half of next year, where hopefully we will be flying and we will be riding in our cars, that we will see oil prices bouncing back quite strongly.
Okay, one last one before I just throw a few viewer companies at you. Crown, $10. Analysts think it's worth $12 plus. A lot of problems, a lot of Royal Commission challenges. But isn't a buy at these levels, Julia, for the long-term investor?
Yes, I mean, Crown was down 4% today on news that the WA Royal Commission will be extended out till March 2022. So we know that it's having problems in terms of licensing and that is a key risk. However, I don't think the share price will fall too much because we know that it's a takeover play and that's in play at the moment. So it's unlikely to fall substantially unless it loses its license. So that's a key risk. The way that I would probably prefer to play casinos at the moment is through Star. Now, Star recently said that they would be taking away their merger proposal from Crown because of those regulatory risks. But also, if we do see a takeover for Crown happening and a third party coming in like private equity, I think that Star's in the key driver's seat to be operating some of these casinos. So it could still end up being a win for Star. Also, if we have a look at casino earnings, once lockdown is lifted, these earnings do tend to bounce back quite quickly and very strongly. And there's almost a defensive type of nature to these earnings. So I probably prefer the lower risk option of Star versus Crown, although Crown, of course, will be driven by that takeover activity.
Okay, a quick four from viewers. Telix Pharmaceuticals, TLX.
Yeah, look, this is an interesting one. I think it was formed back in 2015, and really they're looking at diagnosing different cancers. So mainly in the area of prostate cancer, kidney cancer, brain cancer as well. So look, they are very much moving from, I guess, the research stage into the commercialization stage over the next 24 months, which is quite exciting. So just watching this one carefully, it of course is a speculative play because there isn't a lot of revenue coming in through the door. Having a look at the cash at the bank, they have enough to tide them over for around about 4 quarters. But at that stage, if they don't have revenue coming in through the door, of course, there's a risk of a capital raising as well. But inching closer and closer to commercialization and in that diagnostics area. So looking at targeted radio molecular, I guess, imaging for cancers. And firstly in the area of prostate, and then looking at things like renal or kidney, as well as brain.
Great. Let's go to Ingenia Communities Group, INA.
I quite like this one. I grew up going to caravan parks, but of course, today's caravan parks are about a lot more than just leisure. And Ingenia Communities is also about tapping into that retirement area where, you know, they lease out the land or sell some of the land as well. And the good news for Ingenia is that they are in an upgrade cycle. Recently, they did upgrade their earnings expectations for the last financial year to growth of 30%. So that's up from 15 to 20% previously. And they also said that new lot sales was up by around about 17%. Part of this is that we are seeing a migration away from city centres. And of course, we're also seeing that ageing population as well. And the cost of house prices in capital cities have just blown through the roof. So these type of communities looking a lot more attractive and probably will continue to do so. And those, I guess those tailwinds of things like migration away from city centres, working from home, aging population, those type of themes aren't going to go away anytime soon. So Ingenia really exposed to that area, and we'll probably continue to see some strong growth. And of course, they're predicting 30% growth for the last financial year.
I might write a story about working from caravan parks.
Yes.
All right, let's go to Nexus Minerals, NXM.
So having a look at this one, and I guess it's interesting because it is an explorer, but it is a very small company, a market capitalization of about $22 million. So this is all to do with, I guess, the exploration results. It was interesting having a look at the shareholder register. I noticed that Northern Star has a 2.7% stake in this business. But look, Pete, I tend to stay away from those explorers because it is all on the back of those exploration results. So unless you've got a good idea around some of the properties around that exploration area, it really is a bit of a luck game. So I guess having a look at that gold space as well, it has been a pretty difficult place to be. We sold our Northern Star shares last week for a profit, and this week, they've gone down quite substantially. So gold really struggling to find a bit of a base here, but starting to look interesting from a value point of view, but I'd probably go with more of the producers here.
One final one, Service Stream, SSM.
Yeah, Service Stream is one that has been in a downgrade cycle. And look, a lot of its revenues depend on the NBN rollout, which of course, there's a huge amount of money to be spent. So really, in reality, Service Stream's fortunes really depend on how much work it's being awarded out of the NBN project. Recently, they did announce an acquisition from Lend-Lease, which gives them more scale in that telecom area, but also gives them a more diversified business, which helps them to compete with the likes of Downer, EDI in terms of the market. At these type of prices, I think, it is high risk, but I would be tempted to put a little bit of money in here as a value play. And of course, if you do see some of that NBN revenue coming through to Service Stream, you see the valuation increasing quite quickly for Service Stream on the back of some of those contract wins. So keeping an eye out for the NBN and the rollout, because its fortunes really depend on that at the moment.
Julia Lee, as always, thanks for doing all the hard work on those companies, and I'll talk to you next week.
Pleasure. Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining us now is Jun Bei Liu from Tribeca Alpha Plus. Good to see you, Jun Bei Liu.
Great to see you. How are you?
Well, not really enjoying the lockdown. As you can see, I'm even broadcasting from home rather than our usual studio. But it's good to see we have this Zoom technology which permits us to keep producing our TV programs.
Which is incredible, isn't it? Not many people have heard of Zoom before March last year, and now we use it many times a day, isn't it?
Yeah. Now, you don't invest overseas, but if you did, would you be interested in investing in Zoom?
Absolutely. I think this is a structural winner out of this whole thing. And share price so volatile as investors move on from the selling or the COVID winners. But this is a company that was so little known to investors. Now they structurally have a foothold in so many countries, so many businesses. I think that scale is incredible.
Yeah. And so in many ways, it's being used by business, but I think in the end, families will use this sort of thing as well. And I know I actually just talked to one of our financial planning clients who live in the country, and they'd never used Zoom before. Now he's got a daughter in Melbourne, a son in America. Once we teach him Zoom, he'll start using it with his family as well.
Absolutely. I think the access, I have little kids. My 7-year-old has been doing Zoom play dates. I've been setting up all these Zoom play dates with his little friends, and it's worked incredibly well.
Yeah, exactly right. Anyway, let's get back to Australia now. And I asked, I'm interviewing Larry Diamond for our Thursday investment show. I just want to get a feeling about what the fund managers are saying, because they did present to the market last week. And I must admit, I thought it wasn't a bad report, but the market wasn't all that keen about it. And in the past, you've been a fan of Zip. You have looked at the report. Has the market got it wrong or right?
Look at the moment, market is going through a transition phase. So market is selling a bit of winners, taking profit out of a lot of those winners. As you can see, those buy now, pay later sector have done very well in the last 12 months. So, it's going through a bit of consolidation period. So investors kind of ignoring what's being reported. Now, out of that result, I agree with you. I think it was an okay result. It's beat the expectations by a little bit. And the US business, the core play, is going incredibly well, whereas Australia is slowing a little bit, but that's expected because Australia has reached the very, very high penetration. For the new customer ads, it's expected to slow down, but then it's about how much you can make out of each customer and in terms of transaction value and then the turnover. So, but the US business is actually showing incredible growth, which is actually quite encouraging because that's a much bigger market.
Yeah. So I must admit, I came across a great Warren Buffett quote today where he was saying that short-term investors are a bit like to take a lead from a short-term investor, and a lot of traders in the market, big traders in the market, are like that. That's like calling a person who's big on one night stand as a romantic.
Look, I think it's probably somewhat similar. And I tell you, short-term investing is very difficult. Odds are against you because we don't know what the future might look like. But if you can take a longer-term view, the long-term investing, the share price will eventually follow the earnings. And eventually, the people will get over their skepticism once they grow their earning to a certain extent. And then the share price will follow. So, with long-term investing, in a way, you take out all the noise and things have become easier.
Yeah, you're a romantic investor, aren't you? A one
Absolutely.
night stand trader. Now, so therefore, the question for my viewers then is: do you think if you are a long-term investor, a company like Zip at current prices is looking like good value?
I think it does. And to us, Afterpay, as the leader of the category, also, absolutely deserve investors to have a second look at those names. Yes, they've been sold off because of new entrant and the like, but we always talk to the new entrant. All it does is demonstrating how quickly this category is growing because the merchant wants, the retailer want this product, consumer want this product. It's growing so rapidly. Of course, it's going to generate competition, but the market is so large. Once they demonstrate their ability to go global. So, you want to stay with the category leaders.
Okay, let's go to another one. And you and I have talked about this before, but it's another one, I think, for the long-term investor. And I think also as vaccination rates eventually start to improve here, and they're definitely doing very well overseas, a company like Qantas, is it a buy now for a later return?
Yeah, Qantas is absolutely a buy here. Share price really struggled just because of the lockdown, the stop and start of the economy. Now, this company, many believe that, you require the international travel to return before they can make good money. But remember, for Qantas, the domestic route is most profitable. So as long as the domestic route can recover, which we have seen a V-shaped recovery before the latest lockdown, then it actually generates 80% of its profit, and it's very high margin. So this business is actually will come out of the pandemic once we do, to be a much leaner business and much more profitable business. So it's absolutely a buy at this point.
Okay, now this is a gambling investment. This one, Crown Resorts. It's down to about $10 now. The analysts think it's probably a $12 plus stock. But we don't know what's going on with the Royal Commission and the license implications. But at $10, do you think Crown is looking like a buy for the thrill seeker?
When you talk about this as a gambling stock, it kind of feels like it's a gamble with the volatility, the roller coaster ride that the investors going through at the moment. Look, at $10, you are very paying not that much for the business itself. If you look at the hard asset held by this business, it's around $7. So $7 is hard asset, assuming no license, nothing else, no goodwill. It's just the hotels and properties that on fire sale at $7. So you're really paying very little now for the additional value. And at the same time, you previously, remember, you had two bids on the table. Yes, Star has withdrawn its bid, but still, it mentioned that it's still very interested in the in the asset. So don't forget those bids. And another thing is that those lines, our view is still, and most investors, when you actually take a reasonable view, is that yes, look, it's unlikely for the license to be completely stripped off, in one go. It's very likely we will see some sort of, extension period. So they may lose a license, but extend it for 2 years to see how they go, whether they can remediate, they can improve on their behavior and business and operations, and then they will come through and regain their license. And I think that's a more likely scenario. And with that together, you're really not paying much at this point. But look, news flow, sentiment is very negative, but for a long-term investor, it's really, you buy at the time when there's maximum negativity.
Yeah, because when you think about it, even if another company comes along, even if the Royal Commission says a new company has to hold the license, that company would have to want to buy into those hard assets you talked about, because the casino is inside that fantastic hotel in Melbourne, and similarly in Perth. They go hand in hand together, and there would be a value in there somewhere for a new buyer, and it's probably going to be north of $10.
Absolutely. Look, we think there's a lot of hidden value in this. And honestly, for Star, it's actually a critical moment, because it's very important for Star to have a foothold in this asset, because if it gets taken out by an international player or others, then it creates another competitor who knows how they might compete. So, we firmly believe that there will be some sort of deal happening, and there's more than one interested party in its assets.
Okay, now just quickly, there's just a few companies been thrown us by viewers. If you haven't got a view, let me know. First one is Telix Pharmaceuticals, TLX.
Look, we like this little business. It's got a great rally in the last 12 months. This company provides a lot of imaging products, and has got pretty good momentum. Share price rally into that. Perhaps it's a hold at this point because it rallied quite hard into that. But it is a great management team, and Chris has actually executed very, very well. He runs a portfolio of products, so not high risk like other biotech businesses. So we like this one, but it's more of a hold than chase the share price here.
So maybe it's a buy the dip if the market should.
That's right. That's right.
Let's go to Ingenia Communities Group, INA.
Yeah, look, again, this is a company that's it's done quite well. Recent acquisition has shown that it has a good read-through for its own property assets, and again, it's probably more of a hold at this point, but it's a good it's good business, and the valuation wise is still a little bit of upside, but it's more in the hold range. Buy the dip again.
Okay, Nexus, NXM.
Yeah, this one is interesting. Look, I have much preference for the larger miners, and just because of execution. And recently, we have seen so many, all these large gold miners have had quite a bit of downgrade because of labor shortages and the like. So, I have a preference for the larger ones, but at this point, it seems there is a bit of disruption because of the labor shortages.
Okay, one final one, Service Stream, SSM.
Yeah, Service Stream made a good acquisition, and I think they will have to demonstrate to the market so that they can generate those synergy, because the synergy numbers is being quoted is quite enormous. So perhaps it's on the watch list. It's sort of wait and watch to see the execution.
Okay, that one is definitely for the thrill seekers then.
That's
okay,
right.
Jun Bei Liu, thanks for joining us in the program. See you in a couple of weeks' time.
Thank you very much. Have a good day.
Well, reporting season is looming, and I thought I'd catch up with a good mate of mine, Raymond Chan from Morgans, to see what companies might be worthwhile thinking about before reporting season. And it's not an easy question, but someone's got to answer it. Raymond, thanks for joining us.
Thanks, Peter. Thanks for the invitation. It's a tricky question, given the fact that the ASX 200 now trading around the record high. Yeah. So, but the key theme going into the reporting season, we think most company will able to meet the market expectation. However, if we look at particular stocks that likely to beat the market expectation, I think it is very likely to look into the resources area, Peter.
Yeah. Okay. So let's give us the two. I've asked you to come up with two companies. So let's kick off. What are those companies?
Sure. Both are on the ASX 100, and they're the familiar names. The first one is BHP. I think BHP, as we all know, the iron ore price near the record at the moment, and half of the BHP EBITDA is come from iron ore division. We think the company currently have a very low intention of capex programs. As such, very little spend on the capex, and with and the management being very mindful of total return to the shareholders. As such, they are likely to surprise on the upside on the dividend. Our expectation, even before any surprise, BHP already on a dividend yield of around 6%, and I usually want people not to buy resources on the yield. However, given the significant revenue they generate from the resources area, especially in the iron ore area, I think BHP is the first one. I think there will be a dividend surprise going into the reporting season.
Yeah, and also, Raymond, they seem to be mindful of ESG influence fund managers. They're trying to reduce their exposure to fossil fuel mining, and they're also looking at sort of the minerals of tomorrow, aren't they? So they look like a company that's adapting well to some of the investment themes that have become pretty important nowadays.
Exactly. ESG is certainly one of my key themes for this financial year. And, we continue to see company, to demerge, to sell off, to divest, carbon intensive, business. As in the case of BHP, the market rumor, suggests, they may consider to offload their oil and gas business. Mind you, BHP owns some of the best oil and gas business around the world. And they sort of, want to kickstart a bit early. Of course, if they do divest that part of the business, that will make BHP more concentrated in the area of iron ore. Yes, of course, they got other area, such as, nickel is one area where Peter, you just mentioned. Yeah. Those are the commodity for the future. So they signed a contract with Tesla to kickstart a long-term production on one of the nickel mine, and it's turned out to be one of the biggest nickel mine in the world. So yes, the management are doing their part to address the ESG. For the shareholder, I guess somehow you would rather BHP to be more diversified. However, this is the new world we're going in at the moment. ESG give it the name of the game, and where's the fund flow is coming in.
Yeah, okay. So that's the first one. What's the second one?
Second one, again, investor wouldn't be too familiar with this name, is Aussie Mineral, OZL. OZL is one of the remaining big pure copper play. So they're copper producer with key production coming out from Prominent Hill. They extended the mine life, so they will continue to pump out good revenue from that operation, and also they got other division on the other project on the development. What happened with Aussie Mineral is we think on the back of very significant realized the copper price they achieved it, they will quite comfortably exceed the market expectation. However, traditionally Aussie Mineral don't pay much dividend. on the projected yield of a bit over 1%, we think in this reporting season, the board may actually pay a special dividend. So this is our expectation. It's not guaranteed it's going to happen, but if they announce any special dividend or capital management, I think that will be well received by the market.
Of course, copper is regarded as one of the best bellwether resources for a booming global economy. And we know copper prices have actually spiked, and they have come off recently a bit, haven't they? And that do you think that's partly related to the fact that there were coronavirus concerns that might slow down the global boom that's expected 22, 23? But then given the fact that markets have become positive again and less concerned about the coronavirus outside of Australia, do you think copper has some upside over the next 2 years?
Yeah, there's two sides of the copper story. One side, you're absolutely right. Copper usually seen as a proxy for global growth. So I use Rio Tinto as an example. Many years ago, people look at Rio Tinto as a copper play. Now, of course, iron ore become the bigger part of their business. So yes, proxy for the global growth. Another side of the copper, which become more and more of the investor attention, is the use of copper in electric vehicle. That continue to be a huge demand for that. And the recent profit taking, yes, there have been some concern about the global growth, but not to. I can't help and notice, copper price already doubled on the past 12 months. So a bit of profit taking, I think, is justified. For in the case of Aussie Mineral, I think it's more about the price they realize during the last half, and how are they going to make use of this windfall and reward the shareholders.
Okay, so I guess this is the last question I want to throw at you there, mate. Copper, as we made the point, has been a great proxy for what might be happening in the global economy, and big booms, and copper prices do well. But copper has a new part to it, which you've implied, because it's leveraged into the electronic vehicle and the boom that's going to happen there over the next 5 or 10 years. Copper will have new, in a sense, investor supporters because of its link to the electronic vehicle industry.
Yeah, absolutely. While arguably, the use of copper within the electric vehicle market at this stage is still relatively small. However, we see a growing pie of that capital going into that area. And I think I recall I read one of the studies, over the next 10 years, the demand of copper in electric vehicle is going to double. And remember, the world does not have any significant new funded copper mines for quite some time. So I guess it become very valuable for the existing producer who be able to sell into a very liquid market at a high price at the moment.
So Raymond, for those people who might have a sick portfolio of shares, Dr. Copper might be the long-term solution.
It could be a good diversification for a big portfolio.
Yeah, very, very clever piece of, and also very cautious advice. Well done. Thanks for coming on the program.
Thanks again, Peter.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. And that was Raymond Chan from Morgans, and now I'm joined by Paul Rickard of the Switzer Report. And Paul wants to look at super funds and their very good returns and ask you the question, has your portfolio matched these or even done better? Paul, thanks for joining us.
Thanks, Peter.
So there's a bit of a provocative question, Paul, asking our viewers whether they've been able to outperform super funds.
Well, I think it's a question you should ask, particularly if you're managing the money on behalf of others or you're a self-managed super fund trustee. And even if you're just managing on behalf of yourself, you still got to be honest about it and saying, are you cracked up to be a fund manager? Because if you're not, then it's time to find either somebody else or get out of the business. If you're running your own self-managed super fund, you've got an obligation to perform. And I think one of the ways to measure that is to see how you're going compared to how the big boys in the market are doing.
Yeah, or the big girls, probably.
I should have said, yeah, the big people, something like that. You're right, Peter. Of course, it's an industry, and of course, there's lots of participants.
Yeah, exactly right. And many of the fund managers nowadays are, in fact, women. Let's go to the first chart you've got there, Paul. It's a really interesting one. And I think people will be fascinated not only with the last year's return, but the longer term returns from super funds.
Yes, I just wanted to show how our super funds have been going over the last 1, 3 years and 10 years. Now, this is to the 30th of June, and the data comes from one of the leading super fund researchers, that's Chant West. Now, I've broken the funds into 4 different categories, and that's according to the type of assets they have. So an all-growth fund or a high-growth fund has very much invested largely in growth assets, things like shares and property, whereas down at the bottom, you've got a fund that's pretty defensive and investing mainly in things like bonds and other fixed interest securities. And you can see the variability of the returns, but the key takes, I guess, Peter, last year was a cracker, 18% for the so-called growth fund. That's a median return, but that's a 1-year return, and over 3 years and 10 years, of course, it drops off. And I think Chant West said that last year was the best year in 24 years for super fund returns, and that's a function of the COVID-19 market meltdown we had in the early part of 2020. And secondly, it was actually their second best year on record. So don't get used to 18%. But when you're comparing it, at least you can look at your own return and see, well, how did you do compared to what the industry did last year?
Yeah, that's right. And I think the fascinating one for me, Paul, is, okay, there was a big crash the market, and it was a sensational rebound, faster than we expected, though we expected a rebound, but not that fast.
Yep.
But look at I think, the new investors to the market in particular, they look to see that over a 3 or 10 year period, the high growth option, 9.2% a year, 9.7% a year, that's a nice return, but it's not excessive, is it? It's not really big.
No, I mean, I think if you're thinking about, returns in an environment of ultra low interest rates, and when the cash rate is down to 0%, and share markets, have gone up partly as a result, and we know that in the US, the Wall Street's hitting an all-time record, and the Australian market, we're very close to one. That means that the returns you can expect from the various assets have also gone down. So the idea of expecting a consistent double-digit return, I think, just don't exist anymore, Peter. I think that chart gives you a good illustration after a bumper year last year, but look at it over 10 years, and you see the returns are more like 9% for something that's very growthy, and more like about 5% for a conservative fund. And I think we've got to start to use those sort of numbers in our planning and think about that when it comes to what type of, how much your super money is going to grow over the long, long term.
Okay, let's go to your second slide. I think there's a second really important issue is you actually show us what the various asset categories have returned over time. And Paul, I know what stands out for me, but from your point of view, what do you think is the big message for investors?
I think there are 2 messages. First of all, international shares have consistently beaten Australian shares. Now, I know we all have a hometown bias, and all the research says that, but over those time periods, 1, 3, and 10 years, and it's true over 5 and 7 years, international shares have outperformed the Australian share market. I guess that says something a bit about our economy as well, Peter, because maybe our share market's not as representative of some parts of the economy as it should be. But so it does suggest to you as an investor, and if you follow what the major super funds are doing, you should have some assets outside Australia. That for me is the number one take. Secondly, Peter, the other one for me is that the bond market actually had a negative return last year. Now, normally people think of bonds as super safe, because these are issued by governments And of course, you can't lose money. And if you hold it to maturity, you won't. But in terms of a market price, when interest rates go up, bond prices fall. And so the bond market, investing in the asset class bonds last year, had a small negative return. Over 10 years, you're still getting around up almost 5%. But again, have a look at the difference between the return in shares and the return in bonds. Super safe, 5%. Want to take some risk, you'll get a return more likely around about 9%. And so risk gets rewarded. I think that's one of the other messages.
What also is interesting is that the kind of returns that super funds made in the conservative mode are very similar to what the Australian bonds did over a 10-year period, around 5%.
Yeah, and look, that's pretty much what you'd expect, Peter. So I don't think it's an accident when you get the benefit of 10 years of data and you get some smoothing. So I think that's the first take and a really important thing. So there's no right or wrong way to invest. You've got to invest with the way you feel comfortable about where you are in terms of, life stage, and also what your expectations are. And if you don't want to have sleepless nights, then don't invest in assets that go up and down in price. So the share market is, you only want to have a little bit of exposure to, but if you're prepared to take some risk, then the data says that over time you will be rewarded. Now, we all know that that doesn't mean you can't get one a bad negative year or even a couple of years of negative returns in a row. But over the longer term, you will be rewarded for taking on risk.
Yeah, you get those big rebound years as we saw last year. I think another important point, Paul, is when you look at the performance of international shares unhedged, that's taking out the ups and downs of the currency, which can be annoying on a 1 or 2 year basis, that you can get over a 10-year period, those international shares have returned 14.8%. And it is one of the reasons why with our financial planning clients, we actually do buy local stocks because we know them really well. But internationally, we use fund managers like a WCM or Magellan because they've had a pretty good history of doing well.
And they've done even better than that, Peter, because this, of course, is just the index. So we actually think that in terms of investing offshore, that's where I think a fund manager, it's a much bigger market. It can really, there's a lot more stocks to choose from. I think there's a lot more opportunity to add value than sometimes there is in the Australian market. So I think there's a lot to be said for getting an active style of manager there. I think the hedging unhedged versus unhedged is always an interesting question, Peter, because we all know that currency risk is something that's out there. It's interesting that last year, in the 2021 year, the hedged investors did better than the unhedged investors, and that's because the currency went up. And we had, if you go back to March last year, the Aussie dollar actually hit about 55 cents at the height of the coronavirus market meltdown. And of course, we had a big rally all the way back to 80 cents, and now we're about 73, 74 cents. So we've been saying to clients for a while to be hedged. But over the long term, the data says that there's not that much difference, and it hasn't been that costly being, in fact, it's been to your profit to actually get a bit of currency risk being actually unhedged.
Yeah. And we have to say that on this particular program, we interviewed Michael Knox in about June of last year, who told us that he thought the Aussie dollar was going to 80 US cents. That's one of the reasons why we switched our clients over to hedge. But we'll go back to unhedged one of these days, won't we, Paul?
Yeah, it's just about value for money, Peter, where it is. I mean, I think long term, the Aussie dollar has lost value, and so that's why the unhedged investors have done better. But there are times when the Aussie dollar gets down there that the risk reward says it's better to be hedged. Why have currency risk when the Aussie dollar's most likely move is up? And that's what we've been saying, Peter, as you said at the outset, for more than 12 months.
Yeah, we got lucky. Well, we showed that we're very perceptive. That's what we showed. Now, Paul, if people want to read your story, they go to the switzerreport.com.au website.
Yeah, a lot more. And I really urge people to, look harder how they're doing as an investment manager, or if they've got an advisor, how their advisor is helping them. And then if they're not performing, then really it's time to take some action, because that really is one of the main jobs of being a trustee, is to make sure you're doing the right thing by you and your fellow members.
Yeah, great stuff. Thanks for joining us, Paul.
Thanks, Peter.
And that's Paul Rickard of the Switzer Report. And as I said earlier, if you do want some insights into investing better, having a look at the switzerreport.com.au website might be a really, really good idea. Thanks for joining us on the program. Look forward to talking to you next week. But also, of course, there's the Thursday show. And on this Thursday show, I'll be interviewing the CEO of Zip. That's Larry Diamond. And we'll see whether he can give us a leg up or a leg down for the stock. Thanks for joining us. See you on Thursday.